All right, welcome to this explainer. Today, we're acting as your impartial guide to unpack exactly why one of Wall Street's absolute favorite medtech stocks just suddenly crashed. Boston Scientific was a total market darling. It was up over 50% in 2024, riding high on this incredible momentum. But something broke. So today, we're going to look at the hard data, strip away all the noise, and perform a structural financial autopsy to find out, is this a generational buying opportunity, or are we looking at a really dangerous value trap?
Here's our roadmap for today. We'll start by looking at that massive 60% crash, uncover 4 hidden red flags, analyze the company's eroding competitive moat, evaluate the stock using 3 legendary valuation frameworks, and then wrap it all up by weighing the ultimate bull versus bear case. Let's get right into it.
Starting things off with Section 1, the 60% crash.
So let's just dive right into this breathtaking reversal, right? Boston Scientific hit an all-time peak of $109.50 a share back in September of 2025. Honestly, it seemed completely unstoppable. But fast forward to today, and the stock has plummeted over 60%. It's trading at around $46. Analysts are out there frantically slashing their price targets by $25 to $30. And look, a drop of this magnitude in a major healthcare company, that's not just some standard cyclical dip. It really signals a fundamental shift in how the market views the entire business.
Moving right along to Section 2, 4 hidden red flags.
The very first red flag is the structural collapse of their core growth engine. Wolfe Research actually just downgraded the stock, essentially declaring the 4-year bullish thesis completely dead. And when you look at the contrast, it's pretty stark. Under their old model, 20% of the business, specifically the PFA and Watchman divisions, well, they were growing at a blistering 20 to 30%. That kind of juice dragged total organic growth up to about 10%. But guys, that model is gone. The new reality? Watchman sales are expected to remain totally flat sequentially through the second and third quarters of 2026. So now, a full 100% of the business is growing at just 5 to 7%.
Red flags 2 and 4, they basically revolve around severe execution issues that have kind of just compounded on each other over time. Take a look at this timeline. In March 2026, a class action securities fraud lawsuit drops. The allegation here is that management actually knew the U.S. electrophysiology business was slowing down between July 2025 and February 2026, but they just kept issuing overly optimistic guidance anyway. When the truth about those disappointing sales finally came out in February, the stock plunged 17.6% in a single day. And it brilliantly illustrates how bad news compounds, right? Right after that financial shock, Boston Scientific gets hit with a really disturbing chain of product recalls. We're talking a Class 1 recall for Accolade pacemakers, plus Class 2 recalls for the Orca valve and the rapid refill system. Like analysts have noted, all the clinical data in the world doesn't matter if you can't flawlessly execute on your product pipeline.
And that brings us to the third red flag, which Wolfe Research frankly calls a capital allocation disaster. Right at the exact moment core organic growth is slowing down, Boston Scientific decides to attempt its largest acquisition in 2 decades, buying Penumbra for a staggering $14.5 billion. To pull this off, the deal requires $11 billion in cash and new debt, which pushes the company's net debt to EBITDA ratio up to 2.0x. Taking on that kind of massive debt to just buy growth, especially during a period of such operational turbulence, that is making Wall Street extremely nervous.
All right, let's shift gears to Section 3, an eroding competitive moat.
Now, strictly on paper, this moat looks incredibly impressive. For over a decade, they've anchored their entire business with sustained gross margins of 70.4%. They've got fantastic global diversification, with the Asia-Pacific market growing at 11%. Plus, they are perfectly positioned to benefit from aging population tailwinds, all while historically driving growth through high R&D. By basically all traditional metrics, this is a seriously strong foundation.
But here's the thing, a wide moat doesn't matter much if the water is rapidly draining out of it. And here is the killer statistic that's draining their competitive advantage. Approximately 75% of Boston Scientific's total revenue is now growing at only about 6%. Their high-growth engine has completely stalled out, leaving a massive chunk of the overall business just kind of chugging along at mid-single digits.
So the crucial point to remember is that a moat is really only as strong as your ability to fend off the competition. And right now, Boston Scientific is losing ground. Over in the electrophysiology space, Johnson & Johnson is aggressively stealing market share. Their Varipulse system actually integrates directly with their dominant CARTO mapping platform, and that creates massive switching costs that literally lock doctors into the J&J ecosystem. Meanwhile, in the PFA market, Abbott is fighting this ruthless price and bundling war. When your competitors are squeezing you on both technology integration and price at the exact same time, well, your moat erodes pretty rapidly.
Which leads us to Section 4, 3 legendary valuation frameworks.
First up, we're using Benjamin Graham's framework. This was designed for the ultra-conservative defensive investor, and Graham's formula relies heavily on tangible book value. Now, under this specific model, Boston Scientific's Graham's number is roughly $3.30. Compared to the current stock price of around $46, it looks honestly astronomically overvalued. But hey, we have to be fair here. Graham's formula was built for asset-heavy industrial companies, right? It famously struggles with medtech firms where so much of the value is tied up in intangible assets like patents and IP. Still, it does highlight a serious lack of hard, tangible asset protection at this current price point.
Next, let's apply Peter Lynch's framework, which focuses heavily on the PEG ratio, price-to-earnings growth. Lynch absolutely loved finding stocks with a PEG ratio under 1. And by this metric, Guru Focus actually estimates a Peter Lynch fair value of roughly $62. So looking at it that way, at $46, the stock actually looks undervalued. But you got to remember, the G in PEG stands for growth, and Boston Scientific's 2026 growth guidance has just been brutally slashed from 10 to 11% all the way down to between 5.5 and 6.5%. If that growth continues to fall, that PEG ratio is going to inflate very quickly, and that $62 fair value will just evaporate.
Finally, let's look through Warren Buffett's framework, which is all about prioritizing durability and capital efficiency. Interestingly, Boston Scientific actually passes 8 out of 9 key Buffett metrics. They've got that robust 70.4% gross margin, a super conservative debt-to-equity ratio of 0.4, and really solid free cash flow generation. But it crucially fails his absolute most important requirement, a return on invested capital above 15%. Boston Scientific clocks in at just 9.9%. When you combine low returns on capital with stalled growth, a pending lawsuit, and piling product recalls, man, it is very hard to argue that the company's competitive advantage is truly durable in the Buffett sense.
Let's bring it all together in Section 5, the bull versus bear case.
Let's look at how all these puzzle pieces build the complete picture. The bull case really relies on the fact that analysts still maintain a consensus buy rating with average price targets between $62 and $72. I mean, that represents massive upside from where we are today. Bulls are also pointing to huge upcoming 2027 catalysts, things like FARAWAVE Ultra, Mirus TAVR, and Sysmeek, that could absolutely reignite growth. On the flip side, though, the bear case argues that the growth engine hasn't just paused, it's structurally stalled. Bears are highly concerned about the massive execution risk of integrating that $14.5 billion Penumbra acquisition, not to mention the lingering cloud of regulatory scrutiny from all those recalls, and of course, a securities fraud lawsuit that just isn't going away anytime soon.
Look, Boston Scientific has already fallen 60%. That means a tremendous amount of bad news is already priced into the stock. As we've seen today, it's a high-quality company that's transitioning through a very, very painful structural shift. But as an investor and a focused learner, you have to answer this critical question for yourself. Has the market fully priced in all the slowing growth and execution risks, making this an absolute steal for a patient long-term holder? Or, with flatlining Watchman sales and incredibly fierce competition from Johnson & Johnson, is there even more downside lurking around the corner?
Boston Scientific is undoubtedly one of the most hotly debated stocks in the market right now. So let us know your take in the comments below. Based on the hard data we explored today, are you buying the dip, selling the rally, or are you just watching safely from the sidelines? In a market that completely hates uncertainty, Boston Scientific sure has plenty of it. The only question is if the discount is finally deep enough to match the danger. Thank you so much for learning with us today, and I'll catch you in the next explainer.